afternoon, everyone, for the first post-monetary policy press conference of the new fiscal year. Over the past 2 days, the Monetary Policy Committee reviewed evolving global and domestic macroeconomic conditions and decided to hold the policy repo rate at 6% while continuing with the neutral stance of monetary policy. In doing so, the MPC reiterated its commitment to keep inflation at the target of 4% in the medium term and to remain vigilant on how actual inflation unfolds. In other words, we continue to be data dependent. The MPC noted that while global economic activity and trade have gathered momentum and span, financial market volatility and potential trade wars pose a threat to the outlook. Moreover, crude oil prices have become volatile in the recent period. Considerable uncertainty persists about the pace of normalization, although not the direction, of monetary policy by systemic central banks. On the domestic economy, the MPC's assessment was that while GDP growth in 2017-18 of 6.6% was lower than a year ago, which was 7.1%, there were important intra-year turning points. Most notably, investment demand accelerated in the second half of 2017-18, and recent high-frequency indicators point to some further strengthening, with capital goods production registering a 19-month high growth in January of this year. On the supply side, both food grains and horticulture are estimated to have crossed new records. Industrial activity has rebounded and become broad-based, while the services sector has shown resilience and expanded through most of the year. However, with imports outpacing exports, the trade deficit widened in January and February. CPI inflation has eased to 4.4% in February, and excluding the estimated impact of increase or adjustment in the house rent allowances for central government employees under the 7th Central Pay Commission, it is estimated at an even lower 4.1%. However, with household inflation expectations having aged up and manufacturing firms reporting input price pressures and increase in selling prices, the committee focused on risks to the outlook for inflation. International crude oil prices have become volatile, with a distinct hardening bias from the second half of March. Moreover, aggregate demand is expected to strengthen during the course of 2018-19. A normal monsoon and effective food supply management by the government was seen as mitigating factors. Overall, the MPC assessed the risks to inflation as tilted to the upside. On the growth outlook, the MPC was of the view that the pace of economic activity could accelerate in 2018-19 on clearer signs of revival in investment activity and sustained improvement in global demand. On the flip side, external demand could be adversely impacted should crude oil prices persist at elevated levels or even increase, and trade protectionism intensify. On balance, we decided to remain watchful about the unfolding of these risks, as well as the impact on inflation of forthcoming revisions in the MSP, second-round effects of HRA increases by various state governments, and fiscal slippages. The committee was also cognizant of the implications for food inflation should the monsoon turn deficient temporarily and or spatially, and the uncertainty imparted to the outlook by the recent volatility in crude prices. The committee observed that growth has been recovering in an environment characterized by a pickup in credit offtake and large mobilization of resources from the primary capital market, which should support investment activity going forward. In its judgment, India's long-term growth potential is expected to be reinforced by various structural reforms that have taken place. Given the unsettled global environment, however, the MPC emphasized the importance of strengthening domestic macroeconomic fundamentals, persevering with deleveraging of distressed corporate sectors, rebuilding of bank balance sheets, and the deepening of risk-sharing markets. I now request DG Acharya to comment.
Thank you, Governor. Good afternoon, everyone. I thought I'll talk first about liquidity conditions and then about some market development measures. The surplus liquidity in the system, which had built up subsequent to demonetization and FX inflows until August 2017, the surplus liquidity continued to decline over the last 6 months with corresponding rise in currency in circulation in the economy. RBI has been using multiple tools, primarily reverse repos and open market operation or OMO sales, to absorb the surplus liquidity so as to reach the stated policy